Bond yields hit their highest level in 6 months on Tuesday. The 10-year Treasury yields 2.29%, and at the same time, stocks are falling, with all three major averages trading lower. So what's driving the sell-off in both the bond and equity markets? Let's bring in Ian Weiner, head of equity trading at Wedbush Securities, with us now from Los Angeles. And Ian, why are we seeing yields rise? What's triggering this sell-off in the bond market?
I actually think that there's just a big quantitative unwind that's taking place in the market. I think a lot of investors had the same trade on, which was actually to be long bonds and to be long Germany and long the dollar. And what we've seen is an unwind of that trade where all of those major assets are moving in the other direction. So it feels like what we've seen is just sort of a very crowded trade getting unwound. It's hard to say there's any real fundamental reason for the change, other than you could argue that it got too overextended the other way when, you know, Germans had negative bond yields, et cetera. So that's the only argument, that it's just the pendulum is swinging back the other direction. But in general, it just feels like a very crowded trade that's being unwound.
But why now?
I guess I'd say why not? I think as these things start to take hold, the selling usually begets selling as people look to pack in whatever gains they have on the year. And as if you're long bonds or you're long Germany and you've had such a big move, all of a sudden you start to give back some of your performance on the year, and you decide, you know what, I don't want to go flat on the year. I'm going to book some gains, and I think that's what we're seeing across the board in these asset classes.
And do you think stocks are falling now in reaction to the turmoil in the bond market? I mean, help us make sense of both markets.
Sure, I think that there's no doubt that a higher yield on bonds makes stock less attractive. And I think as people sort of do there is no alternative argument, which they've been making for years now, and as people look at sort of what the drivers are of the marketplace, and they're namely corporate buybacks and mergers and acquisitions, when rates go up, both of those things become less attractive. So by default, it seems like you'll see a drawdown in the U.S. equity markets, in conjunction with the moves in those other assets.
And do you think higher yields send a signal to you that maybe investors think the Fed will tighten sooner rather than later?
Well, it's hard to tell. I mean, I think the consensus is still September. They still said they're data dependent. So my guess is that most people still think that a June rate hike is off the table. I happen to agree with that. You're still not seeing any real inflation anywhere.
Yeah.
And so it's hard to argue just because bond yields are backing up that necessarily means that people are expecting some kind of move from the Fed.
All right, and just real quick, give us your overall sense of the markets. I mean, how should investors be playing this?
I think investors just need to continue to be very, very careful as far as what they own. As if we've seen nothing as of late, a lot of retail-driven names, for instance, Twitter, for instance, LinkedIn, even a Whole Foods, have gotten decimated when they've had bad quarters. So I think people just need to be very careful and just scrub their portfolio and say, all right, why am I in this? And if there's a legitimately good reason, or if there's some sort of higher dividend or something that makes sense from an income level, then there's no reason not to sell yet. But as far as high growth names that may not be that high growth, you need to be very careful.
All right, Ian Weiner, head of equity trading at Wedbush. Thanks to you for joining us.
Thank you.
I'm Scott Gamm, and you're watching The Street.